All right, so this week we had a ton of macro data coming out. We had the GDP growth rate, also the PCE prices, a lot of labor data. So that is something that I will cover in just a few minutes. But now I want to focus right now on the GDP growth rate. So we've seen it coming in a negative. So this marks the first contraction since 2022. And because of this, so the first contraction since here, and because of this, a lot of people have been, panicking over this. A lot of people have been highlighting this. There have been other economic indicators that came in that could suggest that we're heading into a stagflation period. And this is a narrative I've seen quite popular, especially on X. And I've seen some headlines with this that we may be heading into a stagflation period. So today I want us to talk about that. And what a stagflation really means, well, it marks the worst economic environment that we could be possibly in. So a stagflation represents an environment where there is low economic growth, but high inflation and an unstable labor market. And the problem with this is not necessarily it is not necessarily the fact that, there is no economic growth or that there is high inflation, is that there is no solution to it. So usually how the Fed would approach this is, for example, if there is low economic growth, they would simply stimulate the economy through, quantitative easing, through lower interest rates, and so forth. If there is high inflation, they would simply raise their rates and adopt a quantitative tightening system where they would take out liquidity from the financial system. But if you have low economic growth, high inflation, and an unstable labor market, then what do you do as the Fed? Because if you stimulate, you're gonna lead the economy into hyperinflation. But if you adopt a quantitative tightening environment, then you would simply lead the economy into a very deep recession. And that is the problem with the stagflation, is that there is no solution to it. And usually it ends up pretty bad with a pretty bad recession that lasts for, a couple of months or even years, depending on how deep the recession really is and how bad the economy is. So that is the stagflation, and this is what a lot of people have been highlighting because of the latest macroeconomic data. So we had the GDP coming out at negative quarter over quarter. We also had the PCE core prices coming in for April higher than expected, right? And this marks the highest point since July of 2024 essentially. And we also had the ADP employment change coming in at the lowest point since July. So the ADP employment change highlights how many people have got employed essentially, and by this being so low, it signals that not a lot of people have got employed. So we had the negative GDP, right, the low GDP growth rate. We had, let's say, higher than expected inflation, because the PCE is what the Fed uses. The CPI has a fixed formula. The PCE is the adjusted formula that the Fed uses. So this marks that inflation may be having a comeback. And with this ADP employment change, it signals that labor market may be weakening and that we may be heading into this direction of an unstable labor market that leads to a lot of fear and uncertainty regarding especially monetary policies. This is what we've seen. And because of these three economic indicators, people started to call for a stagflation or, for a recession ahead, and a lot of anxiety emerged. But let's now break each one of these economic indicators and see whether this is the reality. Because the reality, and if we correlate this with other economic indicators, might be very different from what the headlines have presented. And never forget that headlines are made to attract engagement. Headlines are made to attract clicks, and they are made to operate on the fears of people. So the fears, and especially the consumers, fear this stagflation, because that leads to a lot of uncertainty, especially regarding their jobs. That leads to uncertainty regarding their wages. That leads to uncertainty in the markets, and normally this attracts the most clicks. And this is why mainstream media oftentimes uses these primal fears of people to attract engagement. And this is a hard fact that it is seen throughout history, that mainstream media uses these psychological fears and uncertainties of people that are hardwired into the brain to just manipulate essentially the masses to attract clicks, because that's what they want. That's how they make their revenue, by attracting more clicks, by farming ads and so forth. So that's why I personally don't trust that much the news and the mainstream media, because oftentimes they present a reality that most of the times is flawed by biases, and it's made to attract clicks, as I mentioned earlier. So let's now break down each of these economic indicators. So moving to this article I've read, and there are a lot of things that also confirm this. The pre-tariff imports that were made. So we've seen a lot of fears regarding tariffs throughout the past few weeks. As Trump has announced tariffs, then he rolled them back, then he announced 0 tariffs, then he announced that deals will be made, and so forth. Okay, so this has led to a lot of uncertainty. Now, because of this, companies have panicked. Companies have taken protective steps into getting the materials cheap while they can, in order to have some stock that they could sell without the tariffs being applied. So this has led to a major boost in imports. Now, the formula of the GDP has imports as a minus. So if imports go up, that will lower the GDP growth rate. That's how it works, because the GDP measures how much money essentially makes, how much money are made in a country. So imports, because the companies use money to pay for those goods to other countries, is a negative in the formula of the GDP. And because of this, because we've seen high record imports because of companies who try to avoid these tariffs, that has led to a lower GDP, right? And I think this is what actually led to this contraction, not necessarily a weak economy, but the fact that we are seeing a historical steps into avoiding tariffs. We've never seen this happening, and that's what I think has led to this economic contraction. And this has led to imports soaring to an all-time high, and also the trade deficit soaring to an all-time high of 162 billion. So this, I think, has led to that lower than expected GDP growth rate. Now I'm talking about the inflation rate. So this is the PCE. But once again, we can use other indicators as well, such as the inflation rate. So the normal CPI, which I think is also a really useful Confluence we can use. So tracking the CPI, we see that it is currently sitting, the CPI year over year, is currently sitting at around 2%. And this marks the lowest level since September of 2024. And if we all remember what happened back in September, we had our first rate cut in over 4 years. So I think that the CPI plays a major role in shaping the monetary policies of the Fed, and that the PCE prices is not strong enough to say that inflation may be coming back. And to add on top of this, I think that it is also worth tracking how commodities perform. So commodities generally front run the inflation. So this is a hard fact that commodities front run inflation, because especially the consumer goods, especially the goods and services that the average consumer uses on a daily basis and buys, that's what shapes the inflation rate. And of course there are other confluences that affect it, but I think that the highest impact is made by these commodities. Of course, a major impact is played by the housing market as well, which as we'll cover in a different video I'm planning on to make on YouTube, has been weakening actually, and we haven't seen a lot of sales, and prices have gone lower than they were, which of course leads to a lower inflation rate. But now let's focus on the commodities and the commodity side. So first we saw oil going down and completing this essentially from a technical pattern. This looks like a bearish flag that just is this consolidation phase essentially, which we've seen, that continues this. This is a bearish pennant. So you had the initial downtrend, then you had this consolidation phase, and then you have this continuation to the downside. So this is oil, and we also had lower prices in essentially each commodity and each consumer good. So eggs have gone a lot lower than they used to be back in February. We also had wheat. Now, I don't know how good of an example this is, but it is going lower. Oats are also going lower. Orange juice, we see this major correction, like this is 50+% correction. Yeah, actually 60+% correction in orange juice. And cocoa is also going down since December. So, you have all of these commodities that are going down. You have all of these consumer goods that are going down, and there are still people who fear inflation making a comeback. Now, the only environment where I see inflation making a comeback is where the Fed makes rushes into making a monetary policy shift and rushing into decision, and that I think could lead to inflation making a comeback, which I think Powell is afraid of, which we'll cover in just a few minutes regarding the monetary policies. I think that Powell is afraid of making that mistake. So we've seen that back in 2021 when the Fed has overstimulated the economy. And I think that Powell has some sort of PTSD from that, where he's afraid of making a bad decision to stimulate the economy, and that would bring inflation up. So that's why I also think he has waited so much with all of these rate holds throughout the past years. And right now we're seeing pretty much the same thing. So this is the inflation. I think, this invalidates the thesis that purely from a fundamental basis right now, if there is no shift in monetary policies and Trump comes to deal with countries, because that's of course a really important factor. If he doesn't, then of course that will lead to artificially higher prices, as corporations tend to pass on prices to consumers, right? So they keep their profit margins intact. But if that doesn't happen, and so if we don't have any sort of shift in monetary policies, unexpected, and we also don't have Trump raising tariffs for China by 200% overnight, then I think we're pretty much still in line for a normal economic environment, pretty much. So I don't think that inflation will make a comeback unless either one of these two things happens. So those are my thoughts on the current inflation making a comeback narrative. And to dismantle the thesis about the weak labor market and unstable labor market, we also had some other economic indicators which came in later this week. The non-farm payrolls, which shows us how many jobs are getting added to the United States economy. And we have seen it coming in really strong at 177,000, which is pretty much where we've seen it throughout the past few years. It has fluctuated between these levels, but Still, a lot of jobs that got added into the US economy, and that I think is a net positive. So the NFP is looking strong right here, and we also had the unemployment rate coming in this week at 4.2%, which is pretty much where we've seen it throughout all of the past few years. So these are still record lows for the unemployment rate, which shows us that the labor market, despite the headlines and despite the fears that we may be heading into a stagflation where the labor market is weakening and we have an unstable labor market, the unemployment rate is still sitting at record lows. So I think that all of the fears have been exaggerated, first by the headlines and secondly by the fact that people have really become emotional. If we see how the market sentiment has developed over the past few weeks, people have really become emotional. So we've seen how fast the sentiment has shifted from extreme fear a couple of weeks ago, so back in early April, from extreme fear and people calling for a bear market, people calling for a recession, people calling for a crash. From that to now greed and people calling for new all-time highs, for, things like that. And so I really thought about this. How will the sentiment look like when we'll eventually have an actual narrative on the table? Because now there is no narrative around it. It's just Bitcoin making a comeback, the S&P going up. This is pretty much the rebound after a correction, right? So this can either be a complacency phase, which we'll cover in just a few minutes. I've seen a lot of problems around that, around me saying that we should track this reversal. So we'll cover that in just a few minutes. And there really comes the question on what's going to happen when we'll actually have a narrative. So that now there is no narrative, it's just the price making a comeback and everyone becoming excited that the price is going up. So yeah, I'm thinking about this. And when talking about this, something I've been tracking, and this is something I covered also in one of my latest videos on YouTube, is gold. And gold reversing this uptrend. So we actually formed this massive shooting star on the weekly time frame, which is the largest shooting star we've seen in quite a long time. And this often marks the last capitulation phase. So if we were to inverse this chart, we would see exactly how this chart would look like. This marks the bottoming formation that often precedes a reversal, whether it's a short-term reversal that is followed by continuation to the downside. Now, of course, this chart is once again inverted, or whether it's a durable reversal and this phase precedes a high time frame, a reversal back to the upside, which in this case would actually be to the downside. Now, I personally think it's likely that we'll see something like this moving on from here, and there are some interesting developments to this. So I've highlighted this thesis sometimes before in the past, but what I want you all to understand and what I'm a big believer in is the efficient market hypothesis. So the efficient market hypothesis essentially tells us that the price includes information. And this is something truly valuable in this. I think, there's a really deep meaning to the fact that the price includes information. So what do I mean by this is that the charts often tell a story, and oftentimes the price is what leads the sentiment, as I explained earlier, with the rebound on Bitcoin and S&P leading to euphoria, and oftentimes that leads narratives. So we have this very interesting correlation between the price action, the sentiment, and the narratives that the mainstream media uses in order to attract engagement and clicks from people. And what this reversal tells us, in my opinion, is that we'll see a rotation out of safe assets into risk assets. So I've been thinking about this. Well, what could the narrative be around? And since we've just seen how the current inflation is looking like, okay, so inflation being at 2.4%, exactly the same level we've seen back in September of 2024, right before the Fed has cut rates for the first time in 4 years. So inflation staying low. The labor market is pretty strong as well. Commodities going lower, signaling that inflation may not be stopping here and may be actually heading lower. So there comes the question on, are we going to see this risk on period? And I think yes. I think the answer is yes. I think that this precedes a larger correction in gold, especially after this very long blow-off top. So this was essentially a blow-off top in gold, mainly fueled by this wall of worry in the markets. So this bull market, essentially this whole bull market we've seen in equity markets, in Bitcoin, in you name it. This bull market was mainly fueled by a wall of worry. So people constantly fearing a potential recession at each consolidation phase. I remember this really clearly. At each consolidation phase in Bitcoin throughout this bull market, the most popular narrative has been around a recession. We had it back in 2023. We've had it back in 2024. We had it now. So the popular narrative was around the recession, and this wall of worry in equity markets has led to gold and safe assets performing so well. But now it seems like that is coming to an end. But once again, these are signals that point towards the fact that the bull market is coming to an end. And what do I mean by this is, as long as traditional assets and safe assets keep on going higher, that often means that we are seeing a healthy market. That often means that we're seeing a healthy environment where investors are both feeling, risk taking or are feeling risk averse. So that is a normal environment where the bull market just continues. And the same concept applies to a smaller scale, which is the crypto market, which we'll cover in just a few minutes regarding the Bitcoin dominance. But the same concept applies to a broader spectrum between safe assets, traditional assets, and risk assets, right? So we have this thing that as long as the liquidity goes and flows into the safe assets, as long as that continues, the bull market in the broader bull market in all of equities and so forth is still intact. But when safe assets are correcting, when we have this in safe assets, that coincides with a risk on period. And as we'll cover in just a few minutes, that often coincides with a really strong narrative that makes everyone become risk taking, that increases the risk appetite of investors. But unfortunately, that often coincides with the cycle top formation. Because at the top, what market makers want in order to distribute and in order to have a strong counterparty, because all of this comes down to liquidity and having a counterparty. When we reach the top, the market makers will want to have a strong counterparty to distribute what they have accumulated throughout this bull market throughout the past few years. They'll want to have a strong counterparty to do it, and in order to have it, they'll need a really strong narrative. So that's why I also think that this correction in gold is preceding this risk on environment and future narratives that could emerge along the way. So what could be the narratives around this? Well, moving on to the CME Fed Watch tool, we see right here, there's a 97% probability that we'll see a rate hold in May. And this has been my base case for many months now, that May will be a rate hold. Now, if you guys remember back in early April when the markets were taking a beating and they were pretty much correcting, everyone was panicking and everyone was screaming for an emergency rate cut. That's when the probability of a rate cut in May was at 60%, while the probability of a rate hold in May was at 40%. But I kept my thesis intact. I said that, a rate hold is most likely going to happen, and right now it is going to happen. Now the point is, if we were to see a rate cut now, a rate cut is not what we want. As we've discussed a few minutes ago about the Fed making a rapid shift, the Fed rushing into a decision, that would be the only factor that could take us off tracks. So that could bring inflation back, that could bring a whole lot of economic problems back, and that could also raise a lot of questions. Well, why are we seeing this emergency rate cut? Because remember, an emergency rate cut is not a positive thing for the markets. A lot of people were saying that it is, because stimulus and additional liquidity and new liquidity that would flow into the markets. But at the core, it is a problem that the Fed is trying to solve by using these rate cuts. So the rate cuts are not a cause. The rate cuts are the effect of an economic problem, an economic weakness. That's what rate cuts represent. And that's why I said that we don't want to see a rate cut happening so soon, such as May, because that would most likely mean that there are a lot of economic problems that the Fed is trying to solve by adding this stimulus and lowering interest rates. That's what I said. And I still believe that. And I still believe that as long as the Fed continues to hold these rates, the markets are in safe territories. And the bull market is in safe territories. When we'll see the first rate cut, I think that the first rate cut after this hold period, when we'll see that, I think that will coincide with a risk-on environment. I think that's where everyone will start screaming that soft landing is happening. I've talked about this in some of my prior videos around the potential narrative that could emerge moving forward that could lead to this risk-on period. And I think that considering the latest macro data, considering the low inflation rate and inflation pretty much reaching the Fed's target of 2%, I think that the most likely narrative that could emerge moving on from here is either the end of quantitative tightening and the Fed stepping away from their quantitative measures and their quantitative tightening measures and declaring their victory against inflation, or the soft landing narrative. So either both or one of these will be, I think, really popular moving on from here. And the reason is it creates a lot of excitement. It creates a narrative around new liquidity that would enter the markets that would send risk assets and equity markets much, much higher than they currently are. That's the whole reasoning behind it. And think about it. Think about seeing the Fed ending quantitative tightening. Do you imagine how the sentiment on X would look like? Everyone screaming that, okay, the Fed finally did it. Finally stepped away from quantitative tightening. It's time for quantitative easing. It's time for these risk assets to go much, much higher. We'll have the super cycle narrative. We'll have the Bitcoin going to $300,000 narrative. That's what we'll see. That's what I think actually coincides with the cycle top formation, this extreme risk appetite coming from investors. And if we correlate each one of these confluences, such as the macro data, the charts of safe assets, of risk assets, how they are intercorrelated, we have the macro data that leads the monetary policies, and the monetary policies leads the correlation of risk assets to safe assets to equity markets and so forth. So they are all part of this big spectrum that is intercorrelated, and it all comes down, I think, to liquidity, for market makers to have a counterparty to trade with at each time. And I think that is what it comes down to liquidity. We've seen a lot of fear in the bottoming formation. We've seen a lot of negative narratives around this. And right now it seems like we're currently transitioning away from that into this environment of euphoria and excitement. So this is why I always say, This is why I always say that it's so important to have an objective market analysis that is not based on emotions, but is based on objective data that you can track, that you have clear invalidation points of, and that leads up to something. Emotions lead up to nothing. Emotions change on a daily basis, headlines change on a daily basis, and I think that the past few weeks of constant changes in headlines, I think that confirm that. I think that is a confirmation of what we already know, that narratives are made for retail and are not sharing objective data, but flawed data that is based to attack the primal fears of people, essentially. So returning to what I was saying earlier about the Fed and how I see the Fed moving on from here, if we look at the probabilities, we see that in June we have a 65% probability of another rate hold, and now it is priced in that we'll see our first rate cut in July. So that is where it is priced in, and from there on in September another rate cut, from then on in October yet another rate cut, and so forth. This has pretty much been my base case to start with. I thought that it is most likely that our next rate cut will happen either in June or in July. I personally see this as healthy. So what I didn't want to see is a rate cut in May. That is a big no-no. A rate cut in June is acceptable. A rate cut in July, I think, is a really good decision from the Fed. If they wait too much with it, they could lead on to that recessionary environment that I discussed, that I talked about in some of my prior conferences, about the Fed essentially having two options right now. So the Fed can either choose between the easy option, which would be to bring inflation back and to step away from their quantitative tightening measures and stimulate the economy through additional rate cuts and more stimulus coming to the economy and more financial support. But once again, that just signals the underlying problem of a weak economy and an economy that needs stimulus, right? That is what it's at its core. So the fact that we're not seeing such a rapid shift, such as a rate cut in May, is, I think, a good indication that the economy is still resilient. And as we discussed earlier, with the labor market and labor market remaining strong, with the GDP not being actually negative, but being led by these historical imports as companies try to avoid paying tariffs. So they took these protective steps in buying raw materials and so forth before tariffs would hit. And so we are seeing a pretty strong economic environment right now. And so I think it will be worth tracking whether it will be weakening, moving on from here, or whether it remains strong. Because the Fed could continue with this holding. I think July is pretty much where we want to see our first rate cut. I think July it is. If they wait it out until September, I don't know. Because I said there will be two scenarios. So the first one would be this inflationary environment, that they step away from their quantitative tightening measures. Okay, I explained that. So the second scenario would be the Fed choosing the recessionary option and the hard option on the short term, but that leads to a healthier economy on the long run. And that would be to wait it out. So wait it out and let the economy fall into a brief recession, letting the GDP go negative for some months before they would eventually slowly step away from their quantitative tightening measures, and that would be just to avoid bringing inflation back. I think that would also coincide with a personal bias of pulse just to avoid bringing inflation back and avoid making the same mistake as back in 2021. That could be it, though I find this scenario unlikely to occur. And studying historical reference points, the Fed has always chosen the easy way out. The Fed has always chosen the inflationary way and to stimulate the economy, to avoid letting the economy fall into a recession, because it all comes down to political support, right? It all comes down to that. Because if you let the economy fall into a recession, well, a recession means, layoffs. A recession means that consumers and households are no longer able to afford paying for products and for the standard of living. And that leads to a lot of social problems, which both the government as well as the central bank want to avoid. So this is why the Fed has historically chosen the easy way out, avoid these social problems, because they do not help, especially with the political support. But they could also choose the hard way out, though I find it unlikely to happen. But just for, the sake of debate, there's also this possibility that the Fed could choose. Moving on from here. So this is something that I've been thinking about for the Fed, and keeping this bearish scenario in the back of my mind is keeping me somewhat conservative, especially with my upside targets on Bitcoin and the S&P 500 and so forth, and how I'll approach my risk management moving on from here. I always think that having conservative targets and seeking to be somewhat early in the market, so both early in buying and early somewhat in selling. Of course, you don't want to be too early, because at that point you'll just find yourself buying into a falling knife and then selling on too early, and maybe you then FOMO back in higher to actually buy the top. But generally you want to be somewhat early, because a lot of people tend to have this tendency of being late, and you never want to be late, because if you're late, then you'll just miss the opportunity to buy low and you'll miss the opportunity to sell high. So it's this, are we too early or are we too late? There is this debate, Personally, I try to have a more conservative approach each time, and I try to approach the markets in this, gradual manner, level by level. And especially when I try to either accumulate or I try to de-risk, I take the markets level by level and say, okay, what is more likely to happen? Is it more likely that we'll keep on going higher, or is it more likely that we'll go lower? And then you have your risk reward perspective, where you think, well, where is the reward perspective? So where is the most reward? Is it in favor of the buyer or is it in favor of the seller? So that's how I pretty much approach the markets each time. And this perspective has really helped me to avoid making mistakes and avoid FOMOing at the top, avoid, fighting the bottom or fearing to buy at the bottom. And we'll talk about that in just a few minutes, about early April and what has kept me strong and motivated to say that the bull market is still not over. This is pretty much what I'm seeing right now for the Fed and for the monetary policies, as well as the potential narratives that could emerge moving on from here with the gold and the potential transition into this risk on period. So now let's move on to the S&P 500 and see the impacts that interest rate had over the years, and especially the impact it had on the sentiment. I think that a major role in shaping the markets over the last couple of years was played by sentiment and emotions. So when we talk about this, I want us to look at this period between late 2023 and late 2024, let's say. So this period where we had this impulse up. This was a brief Goldilocks economy. So this was a brief Goldilocks economy. A Goldilocks economy represents the best possible environment for the financial markets. So Goldilocks economy represents an environment where there is a high economic growth, so a high GDP, relatively low inflation rate, and a really strong labor market. And throughout these years, throughout these months, we've seen that exact thing. And that, I think, has led to this major impulse up, despite all of the fears of a recession, despite all of the fears regarding, that the Fed was at historic highs with interest rates. So these levels haven't been seen since the 2000s. So more than 2 decades. And still we had this major bull market because, as I mentioned earlier, it was a brief period of a Goldilocks economy. And a Goldilocks economy primes businesses both from a fundamental level, as it allows for businesses to grow. And in a Goldilocks economy, we have a productivity boom, meaning that, and a productivity boom is where businesses are extremely productive. They have, with little input, they have an enormous output. And it often coincides with a technological advancement. We had a similar period back in the early 2000s, which eventually led up to that dot-com bubble. So this is something that I'm currently making a video on in a much detailed manner. So make sure you stay tuned for that as well. But the point I'm trying to make here is that we had this brief period of Goldilocks economy. And even though interest rates were at historic highs, it has led to a lot of confidence in the markets, because this productivity boom leads to positive wage price correlation, meaning that companies can afford to raise wages without raising prices. So they can raise wages for their employees without raising prices to keep their profit margins intact, because the productivity is what drives a lot of revenue, and so they do not need to raise prices in order to have that. And that just fuels this economic boom, because by not raising prices, it doesn't fuel inflation, but it fuels economic growth and economic activity as wages grow. So this was what we've seen back in 2024. Now, and this is pretty much the good twin of the stagflation. So think about a Goldilocks economy as the good twin, and think about the stagflation as the evil twin in an economy. That's pretty much how I see it. And right now, it seems like we may be heading into a brief similar period to that, meaning that we could be seeing some additional rate holds. So some additional rate holds in the coming months that could lead to this brief moment of certainty. As I mentioned earlier, a major role is played by emotions and relative confidence of investors, because back then investors felt really confident in companies, felt really confident in their fundamentals, and felt really confident investing in equity markets because the macroeconomic environment was so stable. When we saw that changing, when we saw that all of those fears and uncertainties regarding tariffs, regarding, how will the Fed react next, because nobody really knew what was going to happen next, because the headlines change on a daily basis, we've seen this major correction. So this is what uncertainty looks like, and this is what confidence looks like. And I think that we may be heading into a similar period of confidence in the markets going forward, because we're seeing pretty much the exact confluences we've seen back then. So the macroeconomic environment is heading into this period of relaxation, let's say, where we have a relatively stable economic growth, a relatively stable and low inflation rate, and a really strong and tight labor market. That's what we're currently seeing right now. And I think that the main focus right now, and the ones that will outperform will not be equity markets anymore, because circumstances, even though they look similar, they have changed a bit. So instead of equity markets outperforming right now, I think that it's likely that we'll see this brief moment of economic confidence where investors know what will follow next for monetary policies. The Fed also knows what their plan is going to be like. So they'll keep holding rates, then they'll start to take them down. So in these next months, I see equity markets entering a complacency phase. So major indices such as the S&P 500, DJY, QQQ entering a complacency phase, something similar to this, where we have this consolidation period as there are liquidity outflows. So while there will be that whole euphoric environment and everyone being excited because soft landing and saying that we're in the Goldilocks economy and transitioning away from quantitative tightening and the potential start of quantitative easing, that's where I think equity markets will enter this complacency phase, which oftentimes is this high volume phase with high volatility, which allows market makers to distribute. So fueled by euphoria, fueled by positive narratives, fueled by high volume, it is the perfect environment that the market makers want in order to distribute. And this is what I think precedes the actual bear market in equity markets. But here, I think we'll see a major outperformance coming from risk assets. And this is where I also think we'll have our last leg up in Bitcoin in the next couple of weeks. Now, why do I say this, and why do I say that the spotlight will be on risk assets instead of traditional equity markets and traditional assets, is that if we look at a really interesting chart, which is the IWM to SPX pair, which shows us how small caps are performing against traditional equities in the S&P 500, we see a really interesting correlation. And there is a really similar chart to this, the Total 3 and Bitcoin pair, which we'll cover in just a few minutes. But the main point is, back in 2020, back in 2021, when the Fed was adopting their quantitative easing measures to stimulate the economy and to inject liquidity into the financial system, we've seen small caps outperforming traditional assets in the S&P 500 by a large margin, signaling that there was a lot of risk appetite from investors. When the Fed started to step away from their quantitative easing measures and the total assets of the Fed topped out, signaling that they were no longer injecting liquidity in the financial system, but they were taking it out. When they also started to raise their rates and so forth, that's when the bleed accelerated. So it started, the markets were already pricing in this end of quantitative easing, and when it was official, then it just accelerated, and we've seen this major bleed. So essentially, this 4-year bear market since 2021 all the way to now, from small caps against traditional equities in the S&P 500. And this concept, once again, goes to a much broader scale, and it shows us how risk assets are performing against traditional and safer assets. And this, I think, is a really useful metric we can use to track the sentiment and the risk appetite of investors. Throughout the past few years, and as I covered earlier when we talked about gold, why gold has performed so well over the past few years is that this whole bull market was essentially a wall of worry, where there was a lot of uncertainty, there were a lot of fears each time, but that, unfortunately, even though it leads to bull market in traditional equities and it leads to higher and higher prices, it unfortunately leads to bleed of small caps against traditional equities in the S&P 500. My main argument for why we've seen this bleed in the first place is that the current macroeconomic environment doesn't prime small caps from a fundamental level. So high interest rates, low liquidity, and a low risk appetite of investors is what leads to small caps underperforming, because it doesn't prime their business model. Small caps need cheap financing, cheap liquidity in order to grow their businesses, which they didn't get. And this is why a lot of these companies have appealed to other financing tools such as dilution, as we've seen with the Bitcoin miners. And, from a fundamental level, investors don't want to invest in these small caps because, as I mentioned earlier, their business model isn't primed by this macroeconomic environment. And this, I think, is what quantitative tightening has led to. So when we'll see the Fed stepping away from these quantitative tightening measures and declaring their victory against inflation, that's when I think we'll finally see a transition and a change of this underperformance. That's where I see it. That's where I think it will happen. And that's when I see small caps finally starting to outperform for a brief period against the traditional equities in the S&P 500. So it's a very interesting correlation. If we track the sentiment as well, if we add it to this equation, we'll get an even interesting outcome. Because think about the past few months, how they have been. There have been constant fears, there have been constant anxieties, and a lot of capitulation occurring on most of these small caps and altcoins and risk assets. So what if this environment where we have the highest chances of finally seeing a macro catalyst that could, from a fundamental level, change the underperformance of small caps and risk assets, what if market makers made everyone to capitulate right before the outperformance begins? This is something that I've been thinking about, and I don't know if it's right or wrong. It's something that I'm considering, and I don't know if I'm right or if I'm wrong on this thesis. I may be wrong. I may very well be wrong on this thesis, but there are a lot of Confluences who say otherwise. So this is why in the markets, it's so important to have a thesis, have an analysis that you stick to, have, a system that you use and so forth, which is what I'm currently doing by analyzing all of these Confluences and correlating them and seeing seeing what they could lead up to and what are the highest chances and what is the highest probability scenario moving on from here. But it can always fail. So you got to be prepared for multiple scenarios to take place and to be able to adapt to new market circumstances. And a lot of people, especially a lot of semi-experienced traders or investors who know how to analyze these Confluences, unfortunately stick too much to their analysis. So there's a very fine difference in flip-flopping with your bias and in adapting to new market circumstances. And I've explained this many times before. What is the difference between flip-floppers and people who have conviction in their analysis but who adapt to new market circumstances? I believe it is to waiting for fundamental change. So if, for example, we have the second scenario playing out for the Fed, meaning that they'll wait for brief recession to come just to avoid bringing inflation back, that would be the sort of macro catalyst and the fundamental invalidation that would make me adapt to new market circumstances and change this bias and this theory. So that's how I personally see it. And you have a strong conviction into something, but you also have to be able to adapt to the new market circumstances and to stay flexible. Because if you remain really tight and really convicted into your analysis, you might find yourself holding at the top while everyone else is selling because you think the prices are going much, much higher. So if there are certain Confluences that develop, which is also something we'll cover in just a few minutes, then you want to be able to adapt. So that's what I want to add there. Moving to another chart now. We also have the total 3 and Bitcoin pair, which shows us essentially the same concept, but how altcoins are performing against Bitcoin. Now, this shows us the same thing once again, how risk assets are performing against safe and more traditional assets. So similar to what we've seen with the IWM to SPX pair, we have the total 3 and Bitcoin pair. So the same concept applies when the Fed ended their quantitative easing environment. That's when altcoins start to bleed against Bitcoin. But I think that it's likely that we'll see this changing when we'll eventually have a macro catalyst, which I think will be the end of quantitative tightening. So the total assets bottoming out and the total 3 and altcoins finally starting to bottom out as well, and leading to this brief moment of outperformance and to the long-awaited alt season that everybody has been screaming for over the last couple of years. But once again, we have to take into consideration and think about the fact that these alt seasons and the distribution towards risk assets, as we discussed with the S&P 500, occurs only when it precedes a large correction and a bear market. And so this is also why I think that calling for an alt season throughout the past few years, so back in 2023, back in 2024, was a really poor decision. Because calling for an alt season is like calling for a cycle top. And that's why I always say that calling for a Bitcoin dominance correction and crash is like calling for a cycle top formation. Okay, so that's what I want to add there. And looking at the past cycle back in 2019, we find a really interesting correlation to this, that the total 3 and Bitcoin pair bottomed out right when we had this transition away from quantitative tightening back in 2019. So this is a really useful metric, analyzing past cycles. I think it's likely that we'll see the same outcome once again. So the Fed stepping away from their quantitative tightening measures, everybody becoming excited once again, Bitcoin entering this distribution phase, whether it's at $200,000 or at $150,000 or at $120,000. I don't really care about that much. What matters is when we'll see altcoins starting to outperform, weakness in the Bitcoin dominance, everybody becoming excited once again, and a strong narrative that makes retail euphoric. That's when it's time to exit. And I don't really care what the price will be. I will just be watching for these confluences to emerge. Until they do, I think the bull market is still very much so intact. So moving on to exactly this topic, when is the cycle top? What is the cycle top for Bitcoin? This is a post I shared back in March. So as we see here, 14th of March, this is a post I shared where we had this, reversal, and that could lead to complacency phase. So this is a scenario I looked at back then, almost 2 months have passed since. And now we're finally finding ourselves at this reversal point. I've made a post on this. A lot of people were really confused by it. But what I think right now is that this reversal in Bitcoin, which we have seen over the last couple of days, is the one really worth tracking, and the confluences that will emerge moving on from here. As I said here, what we'll need to track will be clear signs of euphoria, altcoins to massively outperform Bitcoin, the Bitcoin dominance showing unusual weakness, and bullish narratives while price forms a macro lower high. And that's when I'll take the cycle top scenario seriously. At that point, I'll start de-risking and build a significant cash position. Until those conditions come, I see no reason to assume that the top is in. And instead, what I said at that point, I'm positioning for a bounce in the coming weeks by gradually accumulating and averaging into this correction. And my base case, as it is currently, is that we'll see a major leg higher before we enter the true distribution phase. And nothing has really changed for me since. Right now we're finding ourselves in this reversal point where it will be worth watching what other confluences develop moving on from here. Whether we'll see Bitcoin starting to form this macro lower high formation, and essentially entering into this complacency phase where there's a lot of euphoria. The Bitcoin dominance is showing a lot of weakness. Altcoins are starting to outperform, and maybe the soft landing narrative arrives earlier than I would have expected, and Bitcoin fails to form a higher high. That is something that I'll have to be able to adapt to. When we'll see all those bearish confluences emerging, that's what I think precedes the actual bear market and a large correction for Bitcoin and the rest of the equity markets as well. But until then, as I said here and as I'm saying right now, I see no reason to assume that the top is in. Okay, and this is when everybody was screaming for a recession to come, for a bear market to come, for, all of these things. So that's what I said here. This is what I'm saying now. Nothing has changed in my bias. Nothing has changed in my strategy. I stick to my strategy. As I said here, I kept hedging at range highs, scaling out of my protective shorts, then DCAing back into my spot holdings to accumulate. That has been my strategy that I've used over the last couple of months to accumulate and position myself for this exact leg up we have seen over the last couple of days. So nothing has really changed. And so these are my thoughts on the current cycle top. And we're finding ourselves at this reversal period, and now it is the most important place for Bitcoin, I think, in this whole bull market, because it will confirm us whether we're actually in a complacency phase that precedes this major move down, or if my base case continues to play out and we'll see a final leg up in the coming months that precedes actually the bear market. So that's pretty much what I had in mind with Bitcoin and the potential of a cycle top. Now, moving on to the Bitcoin dominance. This is really interesting. This is where it gets interesting. Because with the Bitcoin dominance, the thing is, the Bitcoin dominance leads the market cycle. And this is what drives the market cycle. A lot of people throughout 2023, 2024 have screamed for an alt season and for a crash in the Bitcoin dominance. I personally didn't think that was the case. Calling for an alt season is like calling for a cycle top, and I find to call for a cycle top at $30,000, $45,000, $60,000 is a poor decision, right? Back in December, however, that's when I personally started to believe in the alt season thesis. I believed personally that range of between $100,000 and $110,000 would be it. Would be the cycle top formation that would actually precede the bear market. But I was wrong. I was wrong on that, and I acknowledged this many times before. But the fact that, so I made a post back in February, where I said that we could see this alt season. And I made the correlation with the 2021 and the current environment where we had, a similar deviation that would precede the alt season. But take into account, I thought that would have been it. So in my mind, I thought, Bitcoin has reached the point where it is very likely that it'll top out for this cycle. And so now altcoins will most likely outperform moving on from here. But I was wrong on that. And the Bitcoin dominance kept on going higher and higher, which gave me the conviction to say that we're not in a bear market and to reaccumulate over the past few months. So this is what gave me the conviction to say that we're not entering a recession, we're not in a bear market, and in the worst case, we'll have a complacency phase that will form before our true bear market. And so this is pretty much where I'm standing right now. I adapted to this. I adapted to this new circumstance that came in as the Bitcoin dominance kept on going higher and higher and kept on being strong. I adapted to this, and that has gave me the conviction, even when everyone else was screaming for a recession, everyone else was panicking, I kept accumulating. And so far, it is certainly paying off. So these are pretty much my thoughts on the Bitcoin dominance, and as I said earlier, with the S&P 500 and the distribution towards risk assets and Bitcoin and so forth. The same applies to the crypto market as well. When we'll have a distribution towards risk assets, which in this case are altcoins, when the Bitcoin dominance will be weaker and the Bitcoin dominance to start going lower, that's when the cycle top formation narrative and the risks of a potential cycle top are actually present. But until then, until the Bitcoin dominance shows weakness, and as I highlighted here, this is what I'll be watching moving on from here. And this reversal, the Bitcoin dominance and how it performs will be key to track. As long as it stays strong, I think the bull market is very much so still intact. So these are pretty much my thoughts on the Bitcoin dominance. Now I want us to talk about a bit about the low time frames. So as we all know, there has been a lot of noise on the timeline. There have been a lot of debates on whether we'll see a pullback or not. And I've made a lot of videos on this regarding whether we'll see a short-term pullback or whether we'll just see a continuation. As I highlighted today, so a couple of minutes ago, I think our main focus should be on the confluences that develop on the high time frames. So the ones that tell us whether this is a complacency phase or if this is a healthy market structure that precedes the next leg up. That is where my main focus is right now. I don't really care whether we'll see a short-term pullback or not. We might. I'm not excluding it. I took some profits a couple of days ago. I'm prepared for it. If it happens, then I look forward to buy. If it doesn't, then so be it. But my main focus right now is on whether we'll see this complacency phase developing or whether we manage to go higher. And also, my main focus is on the future of the Fed and the path that the Fed chooses to take, whether it is the end of quantitative tightening, which will lead to this risk on period and blow off top and risk assets, or if they choose the less probable scenario where they choose a recession over bringing inflation back. That's where I think our main focus should be right now. Now it's simply the time to step back and to reflect on the broader market picture. It's simply the time to avoid leverage and stay ready, both mentally as well as financially, for short-term volatility moving forward. Leading to the cycle top, there is a major spike in volatility because, as I said with the S&P 500, market makers want volatility so they can distribute. It happens both in these accumulation phases, as we've seen back in 2022. This was an accumulation phase. You see how much swinging there is? You see how much volatility there is? That's how it looks like. And the same applies for this top formation and distribution phase. There is a lot of volatility similar to what we've seen back in 2022. You see how less volatile these moves up were? These weren't volatile. These were just straight moves up, brief corrections, moves up. Then we started being volatile, then straight moves up. And now we're starting to be volatile, signaling that we could be entering in this period of distribution. And once again, the distribution will not look like something like this, and then a correction. No, it will look much more aggressive, similar to this. It will wreck both investors as well as traders. This will be the range, and as funny as this looks like, I think this is there is a higher probability that this ugly drawing plays out than we see a standard ABC type of move up followed by something like this. No, in distribution as well as in accumulation phases, there is a very high volatility that allows market makers to either accumulate or to distribute, because high volatility is what leads to high trading volume, because there is a larger there is a larger spread that is being covered, and because of that, that leads to more orders that are being tapped into and that are being triggered, which leads to higher trading volume. And also, that's what market makers want. When they accumulate and when they distribute, when the prices are in these, brief moments where they go up or down, they don't really want volatility. So the price just goes up or goes down. Instead, when we're in accumulation or in distribution phases, we have the opposite. We have no actual move. And because of that, a lot of investors become either really fearful, as they do in accumulation ranges, or really euphoric, as they do in distribution phases. And in accumulation phases, we oftentimes see bearish narratives. Back in 2022, everyone was saying that a recession was following next. Now I think everyone will say that a soft landing is coming next, and that quantitative easing will push the prices much, much higher of equities and risk assets and so forth. So that's pretty much what leads to these phases. This is where I think our main focus should be right now. Who cares on whether we'll see a short-term pullback or not? The fact that there have been so many debates on this, and both, if I was to talk about this, so let's talk about this, okay? On the low time frames, both bulls as well as bears are right. And I know this may sound, weird, but moving to the charts, on the low time frames, both bulls as well as bears are right. So bulls have a good argument, and something I've been tracking myself is how the on-chain data has developed. Now I don't have it opened right now, but essentially what it was is this is pretty much a vertical accumulation phase. So the price just keeps on going higher and higher. The thing with vertical accumulation phases, and this is where I plan on making a specific video because it's a really interesting concept, it's essentially a period where there are a lot of spot inflows, yet a lot of retail stays overly cautious and overly bearish and keeps on shorting. And because of this, there are certain confluences we can track on how the open interest develops, how funding rates develop. Oftentimes we see funding rates in negative territories, signaling that there are more shorts that are piling in than longs, which oftentimes signal that a potential short squeeze may be following next. And this is what I think happened over the last couple of months, over the last couple of days. And because of this, it has led to a lot of debates where when are we going to see a pullback? Because eventually we will. Eventually we will see spot inflows ending, and we'll see a brief market correction. Because when spot inflows, essentially what keeps the prices high are spot inflows. So each time there is this brief period of a pullback, we have spot inflows that keep the prices elevated. However, when we see those spot inflows disappearing and all of the bids that were on the order block until now, when we see those going away, that's when we'll finally have this period of correction, because the price goes lower to fill up the liquidity. Essentially, that's how it works. So when we see these the spot inflows ending, that's when the prices go lower to fill up the liquidity and sell orders that tend to appear, especially when we test certain resistance ranges. So both bulls are right, because this has been essentially a vertical accumulation phase where more and more shorts kept piling in. So normally prices should keep on going higher to flush all of those shorts and to liquidate them. And bears are right as well in saying that we have a lot of bearish confluences forming on these technical indicators. So bringing some technical indicators out, such as the TSI or MACD or RSI, we see that even on the 12-hour time frame, the TSI has went for this bearish cross. So did the MACD, while there are clear bearish confluences that are forming between the price action, as the price is forming higher highs, while the RSI and the rest of the technical indicators are forming lower highs. And bears are having a good argument in saying that there is a lot of weakness that has been developing on the price action over the last couple of days here, and saying that a short-term pullback may be following next before a potential impulse to the upside. So this has led to a lot of debates. And do you know what this leads to? This leads to everyone focusing on the short term, forgetting completely about what's happening outside the box, outside the short term. So when I see stuff like this, I personally try to be a contrarian in the time frames I focus on. So if everyone is focusing on the high time frames, similar to what they were right here, in saying that, okay, there may be a short-term correction, but we are headed much higher. So buying here is a good idea. That's what you see generally in top formations. So this is where you want to focus mainly on the low time frames, the confluences that develop, and so forth. However, when everyone is focusing on the short term, it means that something else is happening on the high time frames that big guys and smart money is paying attention to, that retail is not. So when retail and a lot of people are debating on, could we see a short-term pullback or not, the main things are happening on the high time frames and the confluences that develop there. So that's why my main focus is right now on these confluences instead of whether we'll have a short-term pullback or not. So with that being said, this is pretty much what I'm tracking currently in the markets, and this is what I've been tracking throughout the past week as we have our weekly market wrap-up. So with that being said, I will wrap up things for today, and I want to thank each and one of you for joining today's conference. I think it has been an amazing talk, and I truly love making these conferences with you guys, as I believe I can share what I'm tracking and my perspectives in a much detailed manner. So thank you all for supporting me and for tuning in to these conferences. If you enjoy them, please make sure to spread the word. And yeah, with that being said, make sure to stay tuned for some of the upcoming videos that are that will be posted in the next couple of days on YouTube. Make sure to stay tuned for tomorrow's space on X. A lot of speakers that will tune in. That will be an amazing talk about the markets and what each and one of us is tracking. So a lot of different perspectives than mine. Make sure to stay tuned for that as well. And yeah, thank you all for joining, and I wish you all a wonderful weekend ahead. All right, see you guys in the next one.